So look, I'm really excited about today because I've got somebody that I've never met before. We've never actually spoken before, but we've exchanged Twitter messages and emails, and I've found him very impressive in his knowledge base of stuff that I know nothing about. So it's good. We're going to be talking about digital assets and a whole bunch of stuff. So Santiago, do you want to introduce yourself and tell us a little bit about you and what you do?
Sure. My name is Santiago Velez. I ran into Raoul on Twitter and actually started watching some of the free videos on YouTube, the Real Vision free access, and I just got sucked in. It was, as much as I may know anything about digital asset space, the financial space was just as compelling. And I believe strongly that those two spaces are in a strong collision course along with a lot of other trends. So kind of went down both rabbit holes at the same time. My background is in engineering. I was a nuclear engineer for about 20 years in power generation. I live in Cape Cod, Massachusetts, in the United States. And I stumbled onto the digital asset space in about 2016 with the emergence of Ethereum. And when I first learned about it, I had known about Bitcoin for a long time, but when I first learned about Ethereum, something about it just, it was like going down a rabbit hole. There's no going back. And I think that kind of transformation for people, that learning curve, at first it's very difficult and intimidating, but when you start to put all the pieces together and understand what the possibilities are, it is just the most amazing thing that you can engage in, for me personally anyway. So yeah, I'm just super excited for the opportunity to get to talk to you and to your audience. And I hope that I can bring some value to the conversation, writ large.
So what I'd love to do first is just get your understanding of, okay, you see Bitcoin, what did you understand it to be then? Because everyone goes through this journey where they think they know what it is. They think they know everything, then they realize they know nothing, and then you start the journey. And then it moves you to Ethereum. So I just want to get that evolution so we can take people through a bit of the understanding, because many people are going to go through the understanding, and I think it's going to help when we move further onto the conversation where this is all going and what's actually going on right now, because I think the narrative is way behind the realities.
Yeah, I 100% agree. When I first understood Bitcoin, it was a way to make money. I'll just be honest. It was, a very speculative asset that was appreciating quickly, and there was a lot of media attention around it. So I'm like, oh, I want to participate in this, obviously. But when I dived into the technology and what's really going on there, and then I started to learn about the motivations behind why it was built in the first place, then a much bigger picture that I hadn't realized prior to, emerged. And particularly some people may or may not know the Genesis block had some commentary about the great financial crisis. And it was a criticism essentially of the failures of the banking system and how precarious it made our society, that we entrusted these institutions with our money and with our economy, and they brought us to the precipice. And Bitcoin was first and foremost kind of a political statement. And I didn't realize that because I was so involved in the technology and in the speculation.
Sorry for interrupting your video, but I have a very important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on the Real Vision YouTube channel, that's just the tip of the iceberg. You should come to realvision.com and see how we're not leaving any stone unturned. From publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts, fellow subscribers, and learn from everyone's experience, which can't be wrapped in a video. It's an experience which you live and learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1 to get a month's access to this incredible content. I don't think it's something you could afford to be without.
precipice. And Bitcoin was first and foremost kind of a political statement. And I didn't realize that because I was so involved in the technology and in the speculation. In hindsight, I think that is one of the most revolutionary conceptual leaps in mankind. I tend to look at things as or the world in general as a number of concurrent patterns or trends. And sometimes those trends never intersect. But every now and then in human history, you get multiple concurrent trends that all intersect at the same time. And this is when you get fundamental change. It tends to simulate kind of a very slow boil situation where, you're adding energy to water and nothing's happening for a long period of time. And then all of a sudden, an emergent property comes out and you get a boil. And that's what I think Bitcoin was. It's this emergence of many concurrent trends in technology, in finance, in politics that are all converging into one place at the right time. And it's the genie's out of the bottle. There is no putting that conceptual leap back into the bottle. The technology is going to change. The people behind the technology and the motivations are going to change. But it is such a conceptual leap, I think, that it can, in my mind, restore some of the inequities that exist in society today. And some of the people who have talked on your channel prior have alluded to this, have alluded to the problems we have with, say, central bank monetary policy, how that affects our lives, or aggregation and compute, in the Amazons of the world or the Facebooks of the world being able to influence policy. I believe that the decentralization current that Bitcoin represents is a countercurrent that can ameliorate a lot of these aggregation trends that are so problematic. So that's what keeps me engaged.
And so how did that then evolve into Ethereum? Because a lot of people are less familiar with Ethereum. So give a little brief breakdown of how you discovered it, what you saw in it, and what it's all about, just so people can get up to speed on this.
Yeah, well, so for me in my learning curve, I really started to go backwards and try to understand what is the basis of value of a dollar bill, of a coin. Where does that come from? I had a very naive preconception that it was maybe backed by some gold somewhere or silver, or maybe it had some redeemable value. I didn't understand what value meant at that time when I first got introduced to Bitcoin and then later Ethereum. So what it did is to challenge my assumptions about where does value come from? And I think a value comes from consensus, right? It comes from a community of people that agree to use something as an abstraction. Okay, so when Bitcoin came out, it was, okay, we have a new way of using technology to achieve consensus. When Ethereum came out, they said, okay, now that we have that consensus, what can we do with it? How can we program it to solve specific problems for us? And so this idea of the programmable money of smart contracts being able to solve specific problems on top of a layer of consensus is where I think Ethereum kind of made the next logical leap above Bitcoin. Not to take away from Bitcoin, but it was just that next logical step in the evolution of money and value. So Ethereum to me it's a wonderful idea where you have this world computer where essentially with smart contracts you can settle payments between people programmatically without a third party. It disintermediates a third party facilitator. The only problem I have with some of these lines of thought is that at the end of the day, we still rely on people. No matter how much we try to abstract value and use technology to lower friction, we still at the end of the day rely on someone somewhere. It's true that code can enforce contracts. It's true that you can use value kind of as an incentive system. So if you want to incentivize a particular behavior, you can use code to do that. And I think Ethereum and Bitcoin have done that very successfully. But at the end of the day, I'm still fairly long on people and the the ability of people to bring new solutions to solve problems. And this technology is just another tool that allows people to do that, to leverage, to be leveraged to be able to solve problems. So Ethereum to me as the next was even more compelling than Bitcoin, just because of the features that it added. And now it just started along this journey.
When you say it's more compelling, you're talking about the token itself, or you were talking about the ecosystem and its potential?
Yeah, so that I appreciate you saying that, because everything is about the ecosystem, right? It is about, at the end of the day, the value. Anything can hold value. We learned toilet paper can hold value during the pandemic. So the real question is, how long can it hold value? Can it persist that value so that it's usable to you in the future, right? So if we abstract value into something that is symbolic, that's transferable, that's verifiable, the next step beyond that is, well, okay, is it going to be more valuable into the future as an ecosystem? I'm not talking about the token. Is it going to be more valuable into the future or not? And so the next question you ask, well, what's being done? What's the activity like? Are the number of wallets rising? Are the number of programmers that are interested in participating going up? There's a whole number of metrics that you can apply to any one of these ecosystems to determine value. And I think that for investors is the most challenging part. In the past, you could look at a company and just look at the balance sheet. You could look at the prospectus. You had these metrics that were pretty much all financial in nature. What we see with the digital asset space is that a lot of the metrics are non-financial. They're more about network value. They're more the metrics that Facebook used to achieve its critical mass. So those are a lot harder to quantify and then be able to extrapolate to the future to say, okay, it's going to be worth more. So as a person, I have to decide, is this ecosystem something I'm interested in participating in and contributing to, because I see as it's worth my time. In the future, it's going to give me a return on that time spent. Now, the token is, I think, important because it's the incentive system that maintains both the security of the network and it maintains the kind of the tokenomic balance of resources, right? So Ethereum has and so does Bitcoin, they have a difficulty curve. And the difficulty curve is essentially it's how hard the compute problem is for proof of work. It's essentially balancing the amount of compute on the network with the demand of the network so that you get a fixed block time. So Bitcoin has a fixed block time of about 10 minutes. It's still probabilistic, but Ethereum has a fixed block time of around 15 seconds. That comes with some trade-offs. Everything is trade-offs. And the way that the network manages that is you have all these people competing to try to earn some Ethereum or some Bitcoin, and they're lending their compute resource to do so. But that demand that supply of compute is variable, but you still want those blocks to come in at around the same amount of time. So you need something else, which is the difficulty curve, to regulate a variable compute supply with a fixed block time. And so the difficulty curve is what enforces that. And there's a reason for that. If you had your block times come in too fast, some of the transactions will come out of order. If you have the block times go too slow, the transactions won't be served, they won't meet the function of the ecosystem to transact value. So this structure is incredibly clever. It's just, to me, it's amazing because it aligns human behavior with incentives. So that's just one small piece of what drew me to this ecosystem, was that kind of behavioral economics component, besides the cryptography and the technology and everything else.
Yeah, I mean, it's super clever. I think people, also the other thing I want to talk about before we move on to the applications and what this actually is unleashed, is there's this Ethereum 2.0 going on right now. It seems to change, and we're kind of used to Bitcoin being Bitcoin, and it's very hard to change. but Ethereum, a group of people, can seem to change it. Talk through about that and what that might mean for value and what's actually going on in that.
Right. Right. So in a decentralized network, you have willing participants. There's no one forcing you to run that code. You have to actively convince people. If you're a developer on the Ethereum blockchain, you have to actively convince people that this next version of your code is better. So you have to go through a process of consensus where these features that you want to introduce into the ecosystem are for the benefit of everyone in the majority. So when you talk about a blockchain like Ethereum moving from proof of work to proof of stake, what you're really talking about is a change in consensus. These are the rules of the game that we all agree we're going to follow going forward. Now, those rules better have a sufficient incentive for a majority of the participants, because if they don't, then they just won't move forward. People will not accept the change. And what we've seen in the past is when there's a split in the consensus of the community, you get an actual fork of the tokens. So you might have Bitcoin and you have Ethereum, but then you'll have Bitcoin Bcash, or you'll have Ethereum Classic versus Ethereum. What they represent is that this organic community has not been able to achieve full consensus, and they've decided to go their separate ways. So the value of the respective ecosystems thereafter is now in proportion to those communities, whatever split they are. And oftentimes, taking the speculative part of digital assets aside for a moment, the value of those communities are now, like I said, in proportion. So as an investor, you would look at, what happened after the fork. Are the communities actively engaged to further developing them? Then that's of interest. To me, it resembles very much more of an organic system, like the way cells divide, and they may carry on new or different properties, or they may mutate. Some cells may become cancerous and die. Other cells may grow and become more fit. So it's a wonderful kind of experiment in these little micro universes where monetary policy can be tried, security policy can be tried. You can have incentive systems tested. These are wonderful little laboratories that you can try all these things and see which is the optimizer for the moment. And that's the key, is that there's no perfect solution. There's never going to be a perfect blockchain or one blockchain that does everything for everyone. I personally believe that instead we're going to have kind of this Cambrian explosion where we have many, many different blockchains, many different incentive structures, all trying to solve different problems and then interoperating. Did that answer your question?
Yeah. So talk to me about that interoperability between these ecosystems, because everybody still right now thinks it's one or the other, or maybe just Ethereum and Bitcoin, but there's a bunch of others in the space that have something to it. How do these things all connect in the end? Because right now everyone sees it as tribal, right? You like Bitcoin, hate Ethereum. You like Ethereum, you hate EOS, whatever it may be, and it's incredibly tribal. How does that resolve itself, and how does that interoperability actually get solved?
Yeah, so that tribalism at first, I thought it was antagonistic to the movement, but in retrospect, I actually appreciate it. And the reason I do is because it is a similar, it's a social incentive. It's not just a monetary incentive, but tribalism is a type of social incentive to drive you towards a particular outcome. The tribalism comes from the fact that people view the space as zero sum, particularly because a lot of this, if you frame it as proto money, it's in the incubation stage. It hasn't grown up and become fully liquid with respect to, say, fiat currencies globally. So there's a lot of concern between tribes that if one particular tribe does better than the other, they'll suck up all the liquidity, and then it will starve out, its cousin or its twin in the womb. So the tribalism, I think, stems from the incentive is that you want your personal investment in both time and money in this ecosystem to prosper, and you're worried that this other ecosystem is going to take away from that. So instead of looking at everything as a zero-sum game, if you step back and realize that all of these things could grow concurrently, just like an ecosystem does in nature, then yes, you'll have competition. Yes, it is a burden on each ecosystem is on them to prove that they're solving problems for their participants. But you can have multiple ecosystems, all dynamically changing over time, adapting, dying, living and replicating, just like a natural environment. And so that's how I see things going into the future is this dynamism. And that's what I think real capitalism is about. I think with the kind of capitalism that we see these days is a crony kind of oligarchical capitalism. And the prospect of digital assets and these ecosystems is, to me, a much better representation of capitalism because they're anti-aggregation. It fights the natural tendency of money to kind of coalesce in one place. And that in itself is a beautiful, that's something that drove me to it as well. So there's just so many things that I find appealing from it.
Fascinating. So where is this space now? And then we'll talk a bit about where it's going. And also, I want to throw in within this conversation about, there's a bunch of things I don't know about stable coins, understanding where that's going, the digital central bank currency. There's a whole bunch of stuff that's all coming out here. So I'd love to know where we are now and then kind of where you think it's all leading to. Because it's a lot bigger than most people realize, I think.
Yeah, I know in your show you've alluded many times to the amount of intellectual capital that's being applied to the space. I mean, it's sucking everything in because of all the compelling reasons we've discussed. I think that the space had a setback in 2017 after you had the incredible bull run and then this capitulation thereafter when the values of all these tokens went down. And of course, there was the ICO phase with the scams and these are natural. I think those are good things because what they do is on the subsequent round, they lift the burden of proof. So the next time that happens, you're going to have your scams, but people are going to start approaching it with the healthy skepticism. Is this the right ecosystem I want to invest my time and money in? And that's a good thing. And that kind of fits and starts. They're good because each opportunity is an opportunity for someone to reassess the space, re-engage, and grow with it. So where we are right now, I think that we are in the build stage. We're not in the massive appreciation stage, but we're in the build stage. People are silently working in the background, which is good, without fanfare, without the hype. They're silently working in the background to build all of these interconnections. And I think the reason we see concepts like CBDC and stable coins arise.
So just to go back to what they're building, I've always said, as a way of explaining it, in the background, some of the smartest people in the world, in big numbers, are building a parallel financial system from scratch for the digital age. It's like an extraordinary project that's going on. It's like, there was, let's think of the channel between Britain and France. There were boats going across, it was the only way going across. But for about 20 years, there was a bunch of guys underneath the water digging one of the greatest engineering feats of all time, was the Channel Tunnel. And then before you know it, everything changes. And suddenly you catch a train in London, go straight to Paris, and life has changed. And I feel like it's that, it's like, that's what's going on, but you can't see it because it's underneath the water and underneath the ground and the tunnel's happening. But, there's a whole financial system being built.
That's right. That's right. And to me, the most important outcome will be if we're able as a species to solve problems with each other with as little friction as possible and with as few intermediaries as possible, while at the same time raising kind of the velocity of value, right? So the exchange of value between people and the opportunity to transact person to person in a trustless way. I think that's just a fundamental benefit that's going to come out of this, no matter how we.
I think 90% of people watching this will say, "What the hell's he talking about?"
Right.
What value do you and I interact, right? The value we're having right now is in a conversation. And yes, there's some value in the video because it appears on a platform. There's a value to your own personal brand. what are we talking about here? Or is this also nascent that it can be many things?
Yeah, I guess, I mean, if you're talking in general terms, yes, it's very nascent. You can assign value to different things, and value is contextual. It changes over time. You know, if I'm in the desert and I'm dying of thirst, and someone comes to me and offers me 20 bars of gold or a bottle of water, obviously I'm going to pick the bottle of water. So yes, gold is incredibly valuable, but in context, at that moment, what I need is water. And if I make it to, you know, civilization and I survive, then the gold becomes far more valuable than water, because now there's a new consensus that I'm interacting with in that civilization that says, you know, gold may be more valuable than water at this given time. So everything is, the way I view it is in context of an ecosystem, a consensus that we form. If the consensus is that this conversation is valuable to the viewers, then it will bring value to your network and so forth, right? If the consensus is that we're just here talking to each other and it is no value, then it'll take away value, and someone will go put their eyeball somewhere else. So how do we quantify that so that we can interoperate, right? How do we move away from a single representative value, which is currency, right? Dollar bills, or ledger balances. How do we move away from that to where we can start exchanging value without currency? That's kind of the end game. Value without currency. So that requires interoperability.
Most of us don't understand value without currency, without it being barter.
Well,
what do you mean?
All right, that's great, because barter is exactly what it is. And that bothers a lot of people because barter is difficult. Barter has a lot of friction. You know, when we bartered 2,000 years ago, you know, one farmer might raise cows to produce milk, and another farmer might raise wheat, and they would try and figure out, with respect to their personal needs, what the value was of that trade. And it was fairly complex. There's a lot of friction to that interaction. There was a lot of slippage, right? So fiat comes along, currencies come along, or gold coins, or whatever you want to. It's an abstraction of the value. It lets you do a few things. It lets you create kind of this level playing field of relative value, but it also lets you carry it into the future. So maybe I don't need the milk right now because it will spoil. I can't consume it all, but I can store it into this coin and then use it later in the future to buy milk when I need it. So the value is contextual, both geographic and chronological. So what do we talk about when we're moving away from a currency-less value? We're talking about bartering. But the difference is we have technology. And the technology is what overcomes the friction of bartering. Technology eliminates the need to figure out in every single little microtransaction what the relative worth of two things is. You don't have to worry about that as a human being anymore. So you can use technology, and I'll go into exactly how that works, but you can use technology to interoperate value without forcing the other side of the transaction to accept your form of value. And that's the real freedom I'm most interested in. Bitcoin to me was extremely compelling because it was this way I could store value apart from the fiat system. There's a criticism of the central bank recklessness. And so I could say, well, you're not acting in a disciplined manner. I'm going to check out of that consensus. Yes, I may still be a US citizen. I'm still going to be affected by your policy. But at a minimum, I could take some of my value and I could store it in this other ecosystem that isn't tied to your policy choices. And that's extremely compelling. That solves a real problem. But we need to be cautious that we don't migrate into a situation where we're all now stuck with transacting in one value system again. This is what's so compelling is we can now say, I want to participate in Bitcoin, but I also want to participate in Ethereum, and I want to participate in all the other digital assets. But I don't want to have to worry about the friction of exchanging those things every day, all the time, because that takes a lot of energy and effort. So the tools that are coming out now to interoperate are just as much of a step change as Bitcoin was to fiat, in my personal opinion.
I can't even get my head around this yet. What does this mean?
Yep.
What are these tools, and how do they work, and what do they do? Because again, this is a very new world for people to understand. I understand, for example, that tokens have solved the cow versus wheat problem, because I can give you a fraction of a cow and get a fraction of your wheat in exchange, and that's what tokens allow us to do in one of the many benefits. But this whole thing you're talking about, I'm still can't quite get my head around it.
No, that's great. Okay. So I'll say that this fourth industrial revolution that we're heading into, Internet of Things, artificial intelligence, augmented reality, digital ledger technology, autonomous machinery, these technologies, they're all programmable, and they all have to work together. It is impossible for human beings to actively oversee these technologies on a day-to-day basis. It's impossible. They just won't work. They won't reach the kinds of economies of scale you need to make it all work and derive the value from it. So what you need is a layer that exists to interoperate all these devices. And let me explain. So you had one guest on recently that talked about the internet as a communications layer, and underlying the internet was our protocol. And that protocol was TCP/IP, and they talked about how packets can interoperate across that information layer very, very easily, right? So if I send you an email, it doesn't matter that I'm on Gmail and you might be on Yahoo or whatever. We can interoperate, right? How does that work? Do you worry about having an account on your counterparty's ecosystem? You don't, because there's a layer underneath that takes care of that for you. And so the Internet of Value is just another abstraction, another layer on top of that. And that layer does the same thing. It facilitates the transfer of value, and I'll tell you how. So one of the key components of value transfer is payments and settlement. You have to be able to settle a transaction between two participants. So if I have some Ethereum and I want to send you some value, but you may not even know what Ethereum is, or you don't want Ethereum, you want renminbi. How do I get my value to you? If we have an abstraction layer, a technical layer, what happens is that I send a micro packet of Ethereum, and it goes to a connector. And what the connector does, they serve the function of being an intermediary, a exchange. And what they do is, as long as that pairing is liquid enough, they say, well, I'll take your Ethereum, and I have a wallet address on the Ethereum ecosystem. I also happen to have an account in renminbi. So I will facilitate that transaction, take my fee or market make, and I'll facilitate that transaction, and I'll forward on the value. So the only criteria that you really need is that the two assets on each end, both the sender's asset and the receiver's asset, have sufficient liquidity in some pairing. Somebody is willing to facilitate that transaction programmatically, okay? Because now everything is being digitized, central bank digital currencies.
So this is why the exchanges are so important in this space, because it's not like a stock exchange where people still think of it as, oh, here's a board of things I can buy and sell. It's actually not. It's a clearing layer for value transactions in different ways. So in the end, a lot of the work that will get done by these exchanges will be that owning that layer of exchange between all of these various things seamlessly that we don't even know. So I just happen to pay in one thing, you happen to receive in the other. I don't need to know or care what you want. You don't need to know what I pay in. But somebody in the middle, the technology in the middle, solves all of that for us without me having to phone up a broker and say, I need to buy RMB because Santiago will only take RMB right now and I can't get it. And then it's a settlement issue and there's government restriction, all of that, it all goes.
And because it's programmatic, it's even more beautiful because pathfinding is a key conceptual piece. That means is you have, say, 3 or 4 different facilitators, 3 or 4 different connectors, and they're all broadcasting their fee. Well, I'll charge you, whatever basis points to facilitate your transaction. The other connector sees that broadcast and says, well, I'll do it for less. And so you have a bunch of connectors. It could be exchanges, it could be decentralized exchanges, but you have a bunch of connectors all broadcasting what they're willing to charge to facilitate that value transfer. And so there's a natural pressure to drive down the costs of that facilitation. So it drives towards lower and lower friction and a lower and lower fraction of the transfer fee. So if I want to send you some value, it may hop across multiple paths, multiple connectors. It may go from Ethereum to a more liquid pair like Bitcoin. Maybe it'll go to the US dollar, and then maybe it'll finally end up in renminbi. So nothing precludes value from finding pockets of liquidity, low slippage, and low facilitation fees. And the software takes care of finding it and facilitating it.
And I guess within that, you can facilitate other people's transactions as you're moving one from the other, because everything happens so fast. Basically, there can be millions of other counterparts who all need a bit of transferring of this and that, and the whole lot kind of jigsaws together. It creates a very liquid market in many ways because the exchange is not between you and me. It's between me into a pool, you into a pool, of which there's multiple transactions, which can all be used to facilitate that. So as you said, it could actually go through 3 different variations before it gets to the RMB. But what we're doing is providing liquidity for everybody in the pool in different manners. That's fascinating.
That's correct. So what do you get? You get this topology, this network of value, right? That's literally what an internet of value is. It's this connection of pockets of liquidity that are facilitated by software. And so you use the technology of ensuring that, look, one of the primary functions of a blockchain is to avoid a double spend. It's making sure that if you have a Bitcoin, you can't sell it to 2 people. You can only send it to 1 person. So the blockchains can do that in a decentralized manner. Centralized servers can do the same thing. A bank can make sure that you can't spend the dollar twice. So a centralized body can do the same thing. So there's no reason that you can't bridge these networks together. There's no reason that so long as that value is not being double spent, it cannot be bridged. And that's a key criteria. So it needs to be sufficiently liquid, and it needs to avoid double spend, no matter whether it's centralized or decentralized.
And I guess that's just an authentication layer, essentially. So,
that's right.
Once you build that on top, then you know that any transaction that comes is authenticated and therefore not a double spend, whether it comes from a traditional database such as a bank account, or it comes from a blockchain-related database which has some sort of larger consensus or proof within it.
Yeah, and the thing about digital assets, like if we were to move to a CBDC or a stable coin, is that they're divisible to quantities that are very, very small.
CBDC, you're talking about central bank digital currency, yeah?
Yes, thank you. Yep.
Right, yeah, let's go to this bit as well, because this is all about connectivity with government systems and a bunch of other stuff as well.
Right. So CBDC is an essential element, and we should differentiate that terminology is not defined yet. CBDCs are in the experimental stage in many forms around the world. There are wholesale deep CBDCs for institutional settlement, to replace a real-time gross settlement system like they have in Europe. I think it's called Target 2 or something like that. But so the CBDC is the wholesale, to settle between banks. But there's also retail CBDC concepts that are being discussed where, you have a central bank issuer creating a wallet address for citizenry that they can then affect monetary policy through. And they're worried about risks associated with that. For example, disintermediating of the banks. So, but the key thing about CBDCs that's different than just a digital dollar is one, it is divisibility. If you think about the connector, what we talked about, this interoperability layer, you can mitigate counterparty risk in a transaction by sending a small amount. And when that amount goes through all the little hops to get to the destination, the person who received it can send a message back saying, I received that small amount. And by the way, I received it in a quantity that I find reasonable. So all the friction along the way, all the hops that it took, and all the market makers or whomever who took a little bit out, it still got to the destination in a reasonably intact. So that person at the destination says, hey, I received it, send me some more. So you send another little bit and you stream the value real time. And what it does is it mitigates the counterparty risk of either a third-party intermediary who's facilitating the transaction.
That's genius, because they're all mini payments, so nobody can take the whole payment, essentially.
That's right. The third parties, the facilitators, the connectors cannot suddenly divert a large payment. And you also get confirmation that it's getting there. One of the things I found most terrifying in this space when I started it was I would send some Bitcoin from my Coinbase account to maybe my offline wallet, and it would be in the network waiting confirmation.
It's terrifying. It's terrifying.
Terrifying. So Coinbase said, I don't have it. My Ledger Nano doesn't have it. Where is it? So it's very scary. So one of the things that people do to get around that is they send a little bit first and make sure that it gets there. And then when they're confident that they have the address right and all these little things, then they send the big bulk. But you still have to wait. And depending on the network, you have to wait whatever the network block time is. And you have to get in line if the fees are high. But the point is, though, is when you use protocols that they're agnostic to the currency. The protocols don't care if you want to use Bitcoin or dollars or Ethereum. All they care about is that you are following certain rules, pathfinding, your messaging for confirmation receipt, and that you follow those rules. And so now you can connect these layers and achieve the goal, which is to transfer the value. So as you can see, you can imagine a situation where velocity rises in orders of magnitude. The velocity of value transfer in the world, I anticipate, is going to rise by orders of magnitude. And that's a good thing, I think, for everyone. And that's very different than value concentrating. I think one of the problems the Fed is having is monetary stimulus. How do you get the velocity of money to go up? How do you get it to where it needs to be to stimulate an economy? I think it's because of the structures that are set up don't really allow for that without much loss. There's a lot of friction there. And so the internet of value, I think, is a way to get around that friction, increase that velocity. And CBDCs are a way that central banks can participate in the internet of value and provide value where it needs to be at the right time.
The other thing I'm interested in is clearly they want to use them to get away from the SWIFT settlement system because it's A, controlled by a centralized source, which is the United States, and B, it's clunky. Making international payments is a pain in the arse. I do it all day, and it's a nightmare. So that gets around all of that. Instantaneous global settlements. You can also then aggregate and group things in different ways in currency terms that you couldn't do before. You create baskets of currencies, much like SDRs, all sorts of stuff you can do with it. But it also is like a hat tip to the fact that governments now need digital on-ramps and off-ramps to operate within this parallel financial universe that they're fully aware is being built, and they know they can't stop.
I 100% agree. And what I foresee in the future is that governments and their respective currency values will reflect their GDP. So it won't be a hegemonic value, right? So if you talk about the petrodollar or the electrodollar, that was a great term. If you talk about that concept, it's hegemonic. That I think is going to be relegated back by this internet of value. Because if you have a situation where people can choose to receive value in the way they want, it really decouples the ability for like the Federal Reserve to influence, trade finance in Southeast Asia, for example. So interoperability is a way to make sure that value properly reflects the consensus of the communities that token represents. And that, I think, is just as true for the dollar or the pound or anything else. It better represent that productive capacity of that society. And if you have a supranational currency, something that like Bitcoin, it represents the productive value or security value of the participants. And they need to weigh each other against each other dynamically. I hear a lot of people talking about always having a reference layer, kind of a base layer, but that ignores the fact that technology doesn't require that anymore. We did need that, but technology doesn't necessarily require that anymore. Now, what does that mean to somebody participating? Like if you choose a currency or a digital asset to participate in, there's risk. So you need to understand the ecosystem you're playing in. And I think you intuitively know that, as if you choose to go dollars or euro or whatnot, you need to understand the ecosystem that you've chosen. That applies just as much to digital assets and supranational currencies as it does to fiat.
And so talk to me a little bit about stablecoins before we move on to some other areas. So stablecoins, obviously, is a digital form of dollar or whatever fiat currency. So it allows me to send you essentially a dollar of value over the internet. I guess that's the way you look at it, right?
That's right. A stablecoin is that term is used as a proxy for a lot of different variations. So if someone says a stablecoin, there are a lot of different ways in which people provide that stability. Some do it, through, we guarantee we have this amount in an account somewhere, and if you audit us, it'll be there. Others don't do that. Others try to collateralize an asset to always maintain the value at $1. So they basically use an oracle where it goes out into the world and they say, well, what's $1 worth with respect to, say, Ethereum? So then you take a bunch of Ethereum, you package it into a ball, and now that's $1. So it's a way of collateralizing it. So there are a lot of variations of stable coins. But the point that the reason they're a useful tool is because they let you go the other way. Just like people buy into Bitcoin as to go against the narrative of fiat. Every now and then, you don't want to be in the Bitcoin narrative. Maybe you're trading or you're speculating. It's good to go back into the fiat system, in this case, dollars, without having to go back to your bank account. So it solves a problem. It allows a quick interchange between whatever position you want to take.
So I want to look at the developments now that are going on and where this is going. So we've kind of framed it now in what's going on, but there's tokenization, there's smart contracts, there's a bunch of things. What do you see? Where do you see this space going? What are the interesting developments that you've got your eye on?
I personally like the idea of using incentive systems of a digital asset to disintermediate large aggregators, like Amazon Cloud, for example. Right? Amazon Cloud has all these data centers everywhere, and arguably one of their main sources of revenue for their business. That to me is just they're asking for it, right? That you got a decentralized system where you can incentivize people to lend their compute and provide the very same services that Amazon provides. And so the key there is that you have to provide that service at an equal to or better level of reliability, and you have to do it at a substantially lower cost because there's switching costs, right? There's risk associated with switching to a new platform. So the largest aggregators, if it's Facebook, Amazon, Google, they're the ones that I think are at highest risk of disintermediation by this technology. And I think they're understanding that. And that to me is the most exciting thing, because I don't want to see a society where we have so much aggregation that, Amazon is the only game in town and all the small businesses are gone. That just to me is not, you mentioned this on your show, that's not an interesting society to me. I would much prefer a way where there's a level playing field where everyone can compete on their merits. And this technology allows that. So that's what personally I'm interested in investing in. Specifically, there are, I won't throw any names as to which specific projects, but if you do some research on which projects are trying to incentivize compute as a service, that would be a great place to invest.
I've been talking to some guys in Canada who are using edge computing, distributed computing, extraordinary, and anybody gets access to it via a browser, which is ridiculous, and can use networks of mobile phones through to universities' computers. So it's really the science community started using it first, where because they need massive computing power and they can't afford it, they basically lease the computing power of the network, and there's an incentive-based system for lending it out. So it means that all of us in the future, right now, we give our eyeballs for a free service like Facebook. We give our attention span, which generally means that we end up imparting dollars on somebody else. But that with the Brave browser, a bunch of these guys, everything starts changing because the incentive systems go back to the individual. So if you want my eyeballs, you're going to pay me for my attention, whether I choose to buy your product or not. And maybe I get double incentivized if I do. That's a different world. I can rent the computing power because, hey, I'm in a different time zone to you and I don't need my computer at night. So I can wake up in the morning and I've earned $3 or, 2 Ether or whatever it may be, because that's the new world. I mean, that's an extraordinary change.
It's amazing. That's why I think as far as that fourth industrial revolution, making all these technologies interoperate, you need that value layer. I've had my cable company call me and say, I haven't had cable for over 10 years. And I've had them say, we'd like you to come back on our platform and we're only going to charge you X amount of dollars for that. And my response to them is, when you start paying me to watch your commercials, then I'll come on. I'll get the cable box in my house. So it's changed the relationship between me and someone that in the past I had all the leverage. Technology changes the dynamic, the leverage that people have with institutions, with aggregators. We see that a lot with, for example, video cameras and how they film public demonstrations and whatnot. It starts to change who has the power in the equation, and it creates a more level playing field in every way. But people have to have the technology to be able to do that. And digital assets in general, I think, are symbolic of people not only having the technology, they're the ones developing it. This wasn't Google who invented Ethereum or Bitcoin. These are people on their own time, without any guarantee of future return, who built this. So it's an organic thing. So I'm very long humanity and long people's ability to solve problems.
It's incredibly entrepreneurial. That's one thing I find fascinating about the space is it's allowing a whole, as you said, a new industrial revolution of opportunity, not only in accumulating value, because right now equity markets are all-time highs, and most asset prices are so high in valuation. Here's going to be not only Bitcoin, but literally millions of new stores of value.
Absolutely.
And whether that's tokenization, it's going to revolutionize everything from how we invest to financial markets to how we exchange things and how we even earn, let's say, universal basic income could come from the renting out of your own attention spans or whatever it may be. I mean, it changes everything.
Yeah, I would be surprised if policymakers start getting very clever and introduce the idea of programmatic taxation, right? So you have this value layer with velocity of money. They're going to want to get in on the action. Right now, they have the burden put on the digital asset investor to self-report, right? But if you can imagine trillions of microtransactions, that becomes impractical. So you're going to need a programmatic way to self-report all these trillions of transactions. And the government's going to put in, I think, taxation layers on code. That sounds scary and dystopian, but at some point you need to fund your society. So governments are going to transition to competing for you, where we're saying, look, we have the best optimized solution for this value. We're going to take this value, we're going to programmatically tax it, but we're going to apply it to as best a society as we can, and we want you to come live here. And so now you're going to start competing.
So what you're talking about there is the government has to exchange value with you for your tax, right?
Correct.
Which right now is one of the issues, is you pay tax and people don't feel like they get the value back. A Norwegian tends to feel that they get value for tax. A German does too, but an American typically doesn't feel they get value for their tax dollar. But when you've got an exchange, you can actually exchange the value.
That's right, and they never had to worry with a competitor. Fiat never worried about a competitor. You didn't have to worry about an interoperability layer suddenly enabling people to be able to buy their milk with Ethereum, as crazy as that might sound. Now you have to worry about that. So you better provide a compelling reason for why I want to participate in your fiat currency. We're not there yet, but that's the direction.
And so it's so much rests around this interoperability, or the ability to exchange anything with anybody. does that not mean that some of these exchanges, I mean, some of these are pretty big companies now, but somebody's going to be the Amazon of this space, or the, Google, because, I mean, if there is a centralization, it could be that one of these takes all and has the vast computing power to be able to deal with all of the matching of all of the multiple value systems.
That's right. You could imagine a situation where a connector, through economies of scale, is able to provide the same service for a significantly lower cost than its competitors, and therefore would acquire market share. That's fine. Let them do that. As soon as they become so big and they want to somehow take advantage of the market, there's going to be another market maker there in the waiting programmatically. So it becomes a natural.
It's essentially perfect competition, because
right.
it's only down to efficiency. It's like high frequency trading. It's a race to zero in both cost and market efficiencies explode because everybody has to get faster and faster and faster, I guess.
That's absolutely correct. That's right. So that's why it has this natural counter balance to aggregation. It's decentralization is one tool that you can counter excessive aggregation. So that's why I'm so bullish on the technology. I mean, you can imagine, Elon Musk had some great ideas with regards to making Teslas, drive around while you're at work and be a ride sharing kind of situation where you could take a liability and make it an asset. How do those cars settle payments? When you have millions of cars driving around doing this thing, where's the settlement layer going to be? Is it all going to be on one chain, or is it going to be car to car, person to person?
I mean, that's fascinating in itself, because now, talking to you about this, you now see all of that economy of us renting out our stuff, our cars, our homes, our manual labor, our brain power, whatever, all can be exchanged in different ways now. And those are trillions of payments. And it's a pain in the arse to have bank payments and everything else, but this thing can basically work seamlessly.
That's right. That's really where I think the growth is going to be. It's going to be in micropayments. It's going to be in machine-to-machine payments. It's going to be in compute, right? Paying for computation. And don't discount the ability of local compute. If you have a Tesla that's sitting there, it's not being utilized as a car. It has an onboard computer. If it can provide a compute service locally, there's no reason for that packet to be sent all the way to some hub in Virginia and then come back. That transaction can occur both on the information layer and the monetary layer right at the site of the transaction. So I don't think people realize how much the interaction between the two layers, the information layer and the value layer, are going to change the way we view assets and liabilities. Just like you referred to transitioning your car into an asset. But everything can be like that. The whole sharing economy.
Oh, so assets and liabilities change. Yes.
Yeah.
Fascinating.
So, yeah, it really is. That's it. I don't think there's anything more fascinating for me personally than this subject right now.
And so, what do you do now in this space? How are you involved in it?
So, 3 different layers. I quit being an engineer, and I decided to become an entrepreneur focused almost entirely in this space. There's a couple of projects I'm working on, 2 in particular, 2 separate companies. So, not much sleep to be had there. But one of them is I'm trying to democratize advertising. And in the other, I'm trying to participate in lending compute to decentralized ecosystems. So essentially becoming a compute provider. And one of the ways we intend to do that is by co-locating with electrical generation. So one of your prior speakers on your channel talked about, we're transitioning from this mechanical society into an electrical society. But if you look at how our grids are set up, electricity grids in the United States, they are designed around a mechanical society. You have all these power lines going everywhere, and these generators generating electricity, and they're running big things like fans and ACs and pumps, things like that. The problem is that sector, if you look at that energy sector, it's not doing very well. It's doing quite poorly. And that's because the information economy is taking a larger and larger fraction of our society. So what I would like to do is leverage that and say, okay, these guys are having a tough time. They need a new customer. And there would be nothing better than to have some on-site compute that they could supply their power generation to, which then could compete with, say, an Amazon cloud or Google Cloud, anything like that. So I'm trying to participate in the space in two ways, trying to democratize advertising, but on the other side, I'm trying to democratize compute in a sense.
What's the advertising business, if you're allowed to say, how's that approaching things? Because that's fascinating to me, because I think that whole space is ripe for disruption.
Yeah, I mean, advertising is incredibly aggregated, either by the Google, Facebooks of the world. And we want to empower content creators. We feel that the real value is in the content creator, right? They're the ones who are providing the content that engage people, who's keeps the eyeballs on them. So why aren't they the recipients of the value? And if we have this interoperability layer, if we have this technology where we can compensate the vast majority of the gains towards the content creators rather than the facilitators, because right now the facilitators are Facebook or Google, through search. How do we empower the content creators? How do they make money? And I think the best way is to connect them with the people who make the products. And, without saying too much about our product, I hope we launch this year. Our goal is to empower content creators to be the advertisers, to connect directly with the brands, and to benefit from this space, from leveraging this technology. So it's how do you direct payment flows? How do you do that as a microtransaction, right? So if a person films a TikTok video, it's a 15-second video, how can they monetize that? Can they make 10 cents out of it, $1, 50 cents? We think that if we empower people to be able to do that, then they will be incentivized to add more content. Not only more content, but higher quality content. So if you combine the idea of streaming interoperable payments with content creation, you can create some what we think are wonderful products. There's a different track that other companies have taken. There's a company called Coil, and you mentioned Brave. These are people who are saying, if you give us your eyeballs, we will stream micropayments to you. So, if I can't afford to, say, buy Real Vision's subscription, well, maybe I really want to watch this one interview. How can I proportionally compensate Real Vision for that interview? But, I just can't afford the whole thing. So here's a technology layer where you could be streaming the content creator real time. So if the person's engaged, and I know your company has very high engagement up till the end of the conversation, you can compensate that real time. So that person is getting real time.
Because of the micro flow, you basically have to pay for the exact engagement that you get. Wow.
Right.
That's
you could combine that with a identity passport, a passport layer, right? Where you could go to multiple content creators. So instead of having a Netflix account, an HBO account, and a Disney Plus account, which I have all of them, unfortunately, because of my children. But if you have all these accounts, I only have a finite amount of time. I can't possibly consume their content. If I had a passport, I could go from content creator to content creator and pay in proportion to what I see. And that would be a streaming payment layer, real-time streaming payment layer. So the sky's the limit. You hit the nail on the head. The entrepreneurial potential is never been greater, in my personal opinion.
There is a reason that some of the smartest people in the world, like Andreessen Horowitz, as a VC firm, has basically pivoted this as their entire investment strategy. And I see it, I've said it many times, people are coming out of the macro worlds like, this is the biggest thing I've ever seen. People coming out of the technology world saying, this is the biggest thing I've ever seen. People coming out of the finance world in general are like, okay, this is an entirely new opportunity. I mean, it's like a black hole sucking everybody and everything into it. And people can't see it. I mean, people listening to this conversation are going to fear change because we have a unbelievable amount of change. I've got a few questions from a few viewers, but before that, When do you think the really serious changes happen? The changes that we see, as all of us, is there's a couple of digital currencies that people understand. They've done quite well, but that's it. There is no applications, there's no use for this thing, it's all worthless. But we all know that there's an extraordinary amount that's coming. When do we see that?
It could be a long time before the retail consumer sees it, and that is kind of a good thing, because what you want is for all this to be so seamless that they don't even notice it. Just in the same way the internet, snuck up on us. The internet literally snuck up on us in terms of whether it's company valuations like Google or Facebook, or growth or use, or the mobile phone and the Apple Store and all these things. They sneak up on you because they're, like we talked about, they're people quietly working on it in the background until they're ready to deploy, and there's an emergent property that comes out of it. There's a benefit to everyone to use it. So I think the retail is going to be the last to see it, but they'll be one of the first to use it, and they won't even know they're using it. This layer will exist in the background, just like TCP/IP exists for information in the background. Most people don't even know what that means, but they use it every day in their mobile phone, their routers at home, their cable, everything. It's all working there in the background. And I think the burden for the Internet of Value is to do that just as well, is to have all this interoperability occur without you having to worry about it. And the people who are the market makers or the connectors, whatever you want to call them, the exchanges, it'll be up to them to get their operations ready for that and as efficient as possible so that they can compete. So the burden is on them to provide the service. And if they don't, somebody else is going to.
Fascinating. Right. I'm going to ask you a quick few questions from some people who've asked questions. Okay, from Ruben. Hi, Santiago. Some Bitcoin experts, some people expect that Bitcoin will be in trouble unless scalability bottleneck is addressed. Any thoughts about Bitcoin scalability, or do you think it's not relevant?
I think it's relevant only so much that if it's going to fulfill a role as a store of value, it has to at least do that for enough people that at any given moment it doesn't seize up the network, right? That's a problem if I want to exit out of the fiat system at a given point in time, and a million other people want to also. If the network can't accommodate that in a reasonable fashion, that's going to lead to a lot of frustration and higher relative
Does the Lightning Network not solve that?
The Lightning Network is a layer 2 on top of the Bitcoin network. The Lightning Network presently still has kind of a high technological barrier to entry for setting up. So for people in investment who see Bitcoin as a kind of a fiat hedge or a store of value, it's not really a practical solution for quickly exiting and entering into that position. The Lightning Network is primarily for a person-to-person payment layer. It's a payment, not a settlement layer. So it's tough to take a position on a payment layer because you still have to settle at some point. At some point in time, you have to settle on the main ledger. You have to get your transaction recorded on a block so that everyone knows that you have that Bitcoin. So I think scalability is very important for Bitcoin, but not as important to achieve a peer-to-peer settlement layer. I think we've gotten past the point where we understand that the security premium that Bitcoin offers is more important than the peer-to-peer transfer premium. So yeah. I feel like they should focus on that, and every ecosystem should focus on what they're good at and get really good at it.
Nothing has to be for everything. There's not one size fits all. Right, next question, because we're already well over an hour. Bitcoin lacks some privacy features that privacy coins attempt to address. What's your view on the privacy coin space?
I think there's definitely going to be privacy coins. I think governments are going to try to regulate them, but they're going to exist anyway. So the real question is, will you be able to interoperate with privacy coins without too much friction, right? What lengths are you going to have to go to use a privacy coin? And that friction has to be less than the benefit of whatever it is whatever surveillance you're trying to avoid. Because frankly, like CBDCs are going to have an incredible amount of surveillance on them. And I don't say that from a dystopian point of view. I just simply think that the central banks really want to aggregate this data. I mean, Goldman Sachs is aggregating the data. JP Morgan is aggregating the data. Visa's aggregating it. They're all benefiting from that data. So we really don't have privacy in our transactions. I think that's false. It's just who is aggregating the data and how are they using it. And I think the central banks are going to want to have that data so that they can have telemetry on the health of the economy at a very micro level. So a use case is privacy. There are going to be situations where people want to transfer value and they don't want a fiat government knowing that. And I think that's going to continue to exist. But again, it goes back to how much friction is there going to be to participate in a privacy-related coin?
Can you give your thoughts on where value will accrue going forward? How much value stays at the Bitcoin Ethereum layer and how much value goes to second layer tokens? And then he asks, is Ethereum the new TCP IP?
Okay, so the first question, I think massive amounts of value are going to accrue on Bitcoin, Ethereum, and all of the other, many of the other digital assets. Some will die. And I think it's just because it's a nascent market, right? It's just naturally, as much as you hear about it, the active engagement by the population of the world is fairly low. So the upside is incredible, right? It's the best performing asset class of the last 10 years. So I think the upside for those assets are incredible.
So somebody, just to bring something else into that point, is somebody asked the question is, do we need all the institutional investment to actually create all this value? Or does value come from, does the value accumulate in different ways than we're traditionally used to? Because we're traditionally used to pension funds allocate capital that creates value for a firm because they can access that capital and it's the share price. This is basically a very different world.
Yeah, it's an accelerant. Institutions entering the space are simply an accelerant, but it doesn't change the endpoint. We're going to get there regardless. Whether the institutions decide to participate fully is really just a matter of how quickly this whole process is going to roll out. It's kind of like saying, would we have had an Apple sooner if, that investment had occurred in the space in the 90s versus the early 2000s? Would we have the iPhone, et cetera? So, yeah, I think that institutions coming into the space are going to have some trade-offs. There's going to be manipulation. In some cases, the certain ecosystems are going to be captured. It's kind of like a whale capturing a smaller fish to consume it. You're going to see some of that. But the overall trend of the Internet of Value is the opposite. The overall trend is more of empowering of the individual and shifting that relationship between the institution and the individual towards the individual. That's my personal opinion. I just think that this is so nascent that you can't see that yet. But we'll see that in time.
Just thinking that through, I mean, I do think there's something in the way that if we can accrue value as individuals without institutions, then you don't need the pooling of value by institutions, which is our pension system, right? We give you money and you give us a pension in return, and then we invest those assets in something else. It kind of disrupts everything.
I firmly believe that. And insurance is one of the main value propositions for blockchain in general, is simply aggregating risk and then doing disbursements at the appropriate time. So that's just actuarial tables. That's just software. You can code most of those functions in. The difference is, how do you convince people to participate in that system? So that's a branding problem. Like, how do they view a decentralized insurance platform, for example? They have to understand that the risks. They have to know that when it comes time to pay out for your car accident or whatever, that money's going to be there and they're going to have the money. So it's more of a branding problem than a technical problem. And then it's bringing enough people into an ecosystem to build a liquidity to make it functional. So it's branding. You have to bring people in to bring the liquidity, to bring it to a position in which it can fulfill its promise, its function.
But then wouldn't us as individuals, this is a new world that empowers individuals, right? So doesn't that allow us to, I guess there's no dissimilar to banks, to deposit it into call it an interest-bearing wallet, of which companies can take it, it's obviously recorded, so they borrow it, they lend it, they do all this stuff, and it comes back to you. You know, there's ways of directly lending your money to accrete value for you and then the third parties.
Absolutely. Right. And you could pathfind. So that's the key. Pathfinding allows you to find the best risk reward proposition. So the companies that more effectively allocate the capital to productive purposes and can return a consistent yield are going to be the ones that people put their money in that particular wallet. So I just think it changes the relationship. In the past, you had to go to a large pension fund or to aggregate this capital to put it towards productive use. But I think it's inverted now.
Yes, I see what you're saying. Brilliant. Right, there's a good question from Chaz as a final question, because I think you've kind of blown up all of our heads. You said, fascinating, thank you so much. On the top of the head, what book or books would you recommend to delve deeper, just based on the kind of stuff that we've been talking about?
Oh my goodness, that's a difficult question. Honestly, any book that talks about the history of money.
Oh, okay.
The history of money, understanding where value comes from, and that it's from consensus. Getting insights into that, I think, is the best at barter systems, because we've been talking essentially about barter systems. I think any book that really describes the human behavior behind barter systems, counterparty risk, trust, those are the ones that are going to give you the best insights into the ecosystems.
Any good books about behavioral economics or incentive systems? Anything that you know of?
I don't, because, where I learned most of this was just reading online, reading other people's analysis of trends. A lot of studies like the Blockchain Research Institute, central bank studies, the Bank of International Settlements, all of these institutions are doing an incredible amount of research on all of these microeconomies and their incentive systems. But you still need to understand human nature at a layer to understand whether the proposed system and this microeconomy is going to be effective. So if you want to be an investor, you have to understand all the risk variables. And one of the
guys who works at Real Vision put up The Ascent of Money by Neil Ferguson. It's actually a great book about the history of money. I don't know if you've ever read it. Neil Ferguson's on the platform today. It's brilliant. And he did a fantastic BBC series on it and wrote a book, The Ascent of Money. So it's really good because it shows you all of the kind of monetary systems, how everything fell apart, just the whole thing. It's really super interesting.
Oh, that's great. I'll have to read that. Thank you.
Okay, I think we've gone on for an hour and 20 minutes. So brilliant. Thank you ever so much. I think people have got a lot to get their heads around within this, and we'll definitely get you back.
I appreciate that very much. And personally, I want to thank you for just introducing me to the whole financial space. I was completely ignorant about it until your channel. So I just want to thank you for that. It means a lot to me.
Thank you. I really appreciate it.
Thank you for watching this video. Now, this is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. It only costs $1 for a month's access. This will be the best dollar you ever invest.